So you're in your 20s or 30s and you're doing the responsible thing, carefully building a portfolio of dividend stocks, thinking you found the secret to getting rich. You've seen the videos, you've read the blogs, buy good companies, reinvest the dividends, and let that passive income snowball roll you into an early retirement. It sounds perfect. It sounds mature. But what if I told you that every dividend check you receive could actually be making you poorer in the long run? In the next few minutes, I'm going to show you how the popular dividend growth strategy might be a huge mistake for our generation, and reveal one simple shift that could be the difference between retiring with a modest portfolio and retiring as a multimillionaire. Section 1. The illusion of free money. Let's kick things off by busting the biggest myth of all, the idea that dividends are free money. It feels like a bonus, right? A reward the company pays you just for being a shareholder. This is one of the most powerful and misleading ideas in all of investing. To understand why, we need to talk about a Nobel Prize-winning idea called the dividend irrelevance theory. In a perfect market without things like taxes or trading costs, the theory states that a company's dividend policy has no real effect on its total value. Here's a simple way to think about it. Imagine you have $100 in your right pocket. Now you take $5 out of that pocket and move it to your left pocket. Are you any richer? Of course not. You still have $100. You've just moved it around. That's basically what happens when a company pays a dividend. When a company announces, say, a $1 per share dividend, on the day the stock trades without that dividend, the ex-dividend date, the stock's price is supposed to drop by about the amount of the dividend. Now, the real world is a bit messier than theory, and other market factors can blur this, but the principle remains. The money didn't magically appear. It was taken from the company's value, which lowers the share price, and was simply handed back to you. Your total wealth hasn't actually changed in that moment. The only thing that has changed is how you hold your wealth. A little less in stock value, a little more in cash. But here's the kicker, that cash isn't free. In fact, for a young investor in their peak earning years, that cash just became very expensive. And that brings us to the first major trap. Section 2. The tax drag trap. This is where the dividend dream starts to unravel for young investors, especially if you're investing in a standard taxable brokerage account. Every time a company pays you a dividend, it triggers a taxable event. Whether you spend that money or, as most dividend investors do, reinvest it, you owe taxes on it for that year. This creates something called tax drag. Think of it as a small, constant leak in your investment boat that, over decades, can leave your portfolio waterlogged. Let's run a simplified, hypothetical scenario. Meet two investors, Investor A and Investor B. Both are 25 and invest $10,000 into the market in a taxable account. Investor A goes the dividend route. She invests in a portfolio yielding 3% per year from dividends and growing 7% in stock price for a 10% total annual return. That 3% dividend gets taxed every year, let's say at a 15% rate. So every year, she loses a piece of her return to taxes before she can even reinvest it. Now, Investor B takes a different path. She invests in a growth-focused portfolio that also returns 10% a year, but it's all from capital appreciation. Because she isn't getting forced into a taxable event each year, her money gets to compound without that annual tax friction. She only pays taxes once when she decides to sell, decades down the road. Let's fast forward 40 years. This is just a thought experiment, but the results are telling. After 40 years of her returns being constantly nibbled away by taxes, Investor A's $10,000 might grow to around $330,000. Not bad at all. But Investor B, whose portfolio compounded without that yearly tax drag, would see her $10,000 grow to over $450,000. When she sells, she will owe capital gains taxes, but the power of tax deferral has already given her a massive advantage. That's a potential difference of over $120,000, lost entirely to the slow, silent drain of dividend taxes. This is especially critical in your high-earning years when you're in a higher tax bracket and don't need the income. Of course, if you're investing only in a tax-advantaged account like a Roth IRA, this specific problem of annual dividend taxes is a non-issue. But for anyone building wealth in a regular brokerage account, this tax drag is a huge and often overlooked opportunity cost. Section 3. The growth opportunity cost. The second major trap is even bigger: opportunity cost. When a company pays a dividend, it's essentially saying, we've made a profit and we don't have enough high-return ways to reinvest this cash inside our own business, so we're giving it back to you. For mature, stable companies like utilities or consumer staples, that's their job. They're cash cows. But as a young investor, your main goal isn't to milk a cash cow, it's to find and ride a rocket ship. Many of the companies that delivered explosive, life-changing returns over the past couple of decades were overwhelmingly companies that paid little to no dividends in their prime. Think Amazon, Google, or Netflix. They plowed every dollar of profit back into research, development, and expansion to completely dominate their industries. Paying a dividend would have signaled that they had run out of big ideas. Now, this isn't a universal rule. A company like Apple, for instance, has delivered incredible returns while also paying a dividend since 2012. But the high flyers are often the ones reinvesting aggressively in themselves. Let's look at the data. If we compare a popular dividend ETF like SCHD to a growth-focused one like QQQ, which tracks the Nasdaq 100, the difference over the last decade has been stark. In the 10 years leading up to early 2024, QQQ delivered an annualized return in the ballpark of 21 to 22%, while SCHD returned around 12 to 13%. Put that in perspective with our $10,000 investment. After a decade, the dividend fund investor might have around $34,000. The growth fund investor could have over $69,000. Of course, that was a historically great decade for big tech, and past performance is no guarantee of future results. Still, it highlights a massive potential trade-off. By focusing on the small, immediate gratification of a dividend, you could be sacrificing a much larger long-term gain. This isn't to say dividend stocks are bad. They just serve a different purpose. They're generally built for stability and income, not for maximizing growth, which should be the number one priority for anyone with decades left to invest. CTA. If you're finding this breakdown useful and want more no-nonsense financial insights, do yourself a favor and hit that subscribe button. It's free, and it helps us make more content just like this. Section 4. The yield trap illusion. There's one more siren song of dividend investing that lures in beginners: the high-yield stock. You see a stock with a 7%, 8%, or even 10% dividend and think you've hit the jackpot. Free money, and a lot of it. But an unusually high yield is more often a red flag than a green light. It's what we call a yield trap. A stock's dividend yield is simply the annual dividend divided by the stock's price. So a yield can get really high for two reasons. Either the company is incredibly generous, or the stock price has fallen off a cliff. More often than not, it's the latter. The market is screaming that there's a high risk the business is in trouble and that the juicy dividend you see is about to get cut. In fact, research shows that naively chasing the highest yielding stocks is often a poor strategy. The outperformance sometimes linked to dividend stocks usually comes from other factors, like being a value stock, meaning it's cheap relative to its earnings, not from the high yield itself. Chasing a high yield is like picking up pennies in front of a steamroller. You might grab a few dividend payments, but you risk getting crushed when the stock price collapses or the dividend is slashed. Solution: the better path for young investors. So if chasing dividends can be a suboptimal strategy for young investors, what's the alternative? The answer is simple and powerful. Focus on total return. Total return is the combination of stock price growth and any dividends you receive. For a young investor, the goal should be to maximize this number over the long term, not just one piece of it. For many US investors, this means shifting focus from individual dividend stocks to low-cost broad market index funds or ETFs. Funds that track the S&P 500, like VOO or SPY, or the Nasdaq 100, like QQQ, give you ownership in hundreds of the world's most innovative companies in a single click. These funds are generally very tax efficient in a brokerage account because they tend to have low internal turnover and their dividend payouts are modest, minimizing that tax drag we talked about. Here's the strategy. For the first 20 to 30 years of your investing journey, your accumulation phase, you focus purely on growing the biggest nest egg possible. You ignore the noise of dividend income and focus on the one metric that matters: the total value of your portfolio. Then once you're near retirement and actually need the income, you can shift a portion of that much larger portfolio into the income-producing stocks and funds we've been talking about. Think of it this way, as a thought experiment. Would you rather spend 30 years building a $750,000 dividend portfolio that pays a nice income? Or would you rather spend that same time building a $2 million total return portfolio, which can then generate an even larger and safer income for the rest of your life? By prioritizing growth first, you give yourself far more options when you finally reach the finish line. Conclusion. So, do dividends still pay off? Yes, absolutely, but primarily for those who need income today, like retirees. For them, dividends are a great tool for generating cash flow without having to sell assets. But for young investors building their wealth, a dividend-first strategy can be a path riddled with unnecessary tax drag and huge opportunity costs, all fueled by the myth of free money that simply isn't real. The surprising truth is that the key to building life-changing wealth isn't about collecting small checks along the way. It's about letting your forest of capital grow as tall and as fast as it can, without constantly trimming the branches for pocket money. Build your foundation on growth. Let your wealth compound relentlessly. Then when the time is right, you can enjoy the fruit from a nest egg far larger than you ever thought possible.